Okay, so in this video, we are going to uncover what some people call the eighth wonder of the world, and it's compounding. And I think it's really powerful because we're going to look at not just how to master lifetime compound growth, but some of the reasons why many people don't get lifetime compounding. And then I'm going to have examples in some other videos about actually like how the life insurance piece works, because it's truly incredible, but it looks a little bit different than maybe how some people perceive in their head. But the first thing I want to just do is define what compound interest is. I'm going to draw, we should have a bad drawings by Caleb Guilliams course or something. But this is supposed to be a compounding curve. And really the power of getting compound interest to work is you need money. So this dollar sign represents you need to fund it, because 100% is zero, still zero. So most people don't actually have a system in their strategy where they can fund it. The second thing is you need to kind of get a good rate of return. When I say good rate of return, mostly here is just consistent. So many people are all over the place because of fees, losses, taxes. They're just not getting a good, consistent, sometimes a negative rate of return. So you got to have a rate of return. But then the third thing is you need to have time. And time is so important. So many people don't even start ever, or they kill I said this in the earlier video, they're killing the goose that's laying the golden egg. And so when we look at this compound curve, we have to figure out, okay, so if we have money and we're earning interest, and that interest is growing on interest, and that's the power of compound growth, we have to commit to this idea of lifetime compounding. Now, the things that kill it, I'm going to write in red, things that kill lifetime compounding is whenever you have to pay an unnecessary tax today or in the future. I'm very public about this, but I think taxes could be the number one threat to your wealth. The increase of future taxes, most people have their money in accounts that have zero control over what taxes could do to them now and in the future. The second thing is losses. And this is not going to be the first time you've heard this either from me, but the idea of if you have $100 and we double your money, 100% on your money, that your $100 goes to $200. Year two, you lose 50%, it goes back down to 100. We just averaged you 25% on your money, but your actual rate of return is zero. This idea of whenever you lose your money in the market, you don't just lose that dollar, you lose what the dollar could have earned you the rest of your life, which makes usually the actual rate of return a lot less than the average rate of return that's toted. And then finally, we want to eliminate this idea of percentage-based fees. I give an extreme example of a penny doubling every single day for 30 days, and you'd have over $5.3 million if you did that. The problem is, if you just paid a 2% fee on that, you'd have less than $3 million. 2% fee ate up over $2 million of your bottom line, and it's because it goes back to the same idea. It's think of you putting money in a bucket, and that fee, it represents a hole in that bucket, and that it's leaking out. You don't just lose those fees that you paid, you lost what that could have earned you the rest of your life. And so we just want to be really careful that the more money that we have, we're not getting taxed on that. Now, these are kind of the wealth compounding killers, and this is kind of what our goal here is. And the goal is, again, write this down, lifetime. Let's commit to a long-term lifetime strategy, and life insurance is the safest and best place to do that. Now, I want to break down kind of why this is so important and why it's important to have a system and an asset that will compound your money for the rest of your life. I'm going to use in this example $100,000. Okay. Now, again, this could be $1 million, this could be $10,000, but the idea is there's a lot of things that trying to attack our money. Now, let's just say that $100,000 could compound for 4%, just 4%. Super conservative. 4% every single year. Okay. Now, over 10 years, your $100,000 would grow to a little bit over $148,000. Now, over 20 years, your money would grow to a little over $219,000. Now, a question that I'll ask is, and this is I'm representing one number class here. This could be $1 million. This could be a lot less. But if you would have spent that $100,000 on something, whether it's a house, whether it's a car, whether it's an investment property, you have what you spent on, but your $100,000 is never able to grow for you. That car that you spent $100,000 on cost you actually $219,000 over 20 years, assuming you can just earn 4%. Now, over 30 years, your money would be worth over $324,000. And over 60 years, and yes, I do believe in this, even though you might not think you're going to live 60 years, we have to think long-term and generationally as it relates to our wealth. Your money would be over $1 million. Your $100,000 would grow to over $1 million. The point I'm trying to make here is opportunity cost. Opportunity cost essentially means every decision you make has a consequence. And when you spend money now, and when you pay cash for things, we are disrespecting the eighth wonder of the world. We're devaluing the thought of our dollar working for us the rest of our life. And again, this just paints a picture of like, I wish I would have known this when I bought my first car. My $10,000 Ford Fusion cost me quite a bit over my lifetime because that $10,000 is never able to earn for me ever again. So the point and summary of this is let's commit to a lifetime compound growth. Life insurance is the best place to compound your money long term and allow you to use it in the short term. And we're going to get into kind of how that works in another video. But I want you to understand the importance of playing the long term game.